Eddie's got some swamp water background going on there. I guess we're in the Louisiana swamps today. Well, if you're looking at the interest rates, they're kind of swampy. I'm not gonna lie. We were told by the experts that as the year progressed, we were probably going to see interest rates in the fives. Matter of fact, they kind of were hinting at it at the end of last year. And here we are into, we're getting knees deep into 2024. And here we are, it's the near fives. We're almost creeping to eights. Like, it's craziness. But, when it comes to mortgages, I always tell you, I'm not the best expert to talk about them, but I happen to know an expert, and that's the best thing to do when you don't know somebody is have somebody else on there to talk about it. And that would be Mr. Kyle Seagraves.
Hello, I love the little audience. I'm a real estate AI that runs the interest rates, creates the interest rates. So I have all the answers here for you.
Every time Kyle gets on, I say he looks like an AI bot.
I'm a real boy.
He's a real boy, he says. But it's like the background is so perfect. Your lighting is impeccable. And you have that.
I'll turn it off.
Oh, look, I say you have a voice of moisturizer. So it's like you're so perfect that you look.
Still
AI.
haven't figured out how to respond to the moisturizer thing.
I stole that line from somebody. I can't say that was the original one. Happy Sunday to you, Betty Boo. We got some people already in the chat. We're going to be talking about the interest rates. If you haven't yet, there is a poll at the top there that is asking you to go ahead and tell me what your interest rate would be for you to decide to buy a home. Because a lot of people, I mean, this, are looking at this like, hey, I'd really like to move. I'd really like to sell, but I'm locked in at a 2.7. And, I'm looking at interest rates right now and I'm like, no, I mean, I can just deal with my tiny house for a little while longer because I'm not going to buy a house at, near 8%, So there's a poll out there that says what percentage rate would get you moving. I mean, a lot of people are saying, oh, it has to be the threes, but I don't think that's going to happen for a long time.
Someone else is saying too, it's not just the interest rates, the sales price as well. And it's like as both continue to go up, it's exponentially worse for a lot of people because even if rates come down, the price is still going to be high. And I think what a lot of people are fearful of is if we see rates come down, competition may increase in a lot of markets too. Creating more incentive for buyers to bid even higher and potentially make home prices go up even higher.
Well, that is a very good point because if interest rates like all of a sudden drop to 3, don't you think a lot of people that were on the fence or even it would cause mayhem? Mayhem.
If we hit 3, oh my God, yeah, that would be crazy. Everything would bottom out. I think the economy would just stop existing if we hit 3 all of a sudden.
Yeah. Well, yeah. But all those people that were even on the fence or even kind of sort of contemplating it, they're like, well, I'll just sell everything in a house.
Yeah.
I think it would be almost, if they were to do that, honestly, I think it might be like a 2007 situation where people would take really risky loans and buy more than they could afford. Like they would cap out the top that they could be qualified for, they would purchase. That's what happened back in my day when I got into real estate. People were hitting the top of their mortgage, not even furnishing it. They were like, well, I can furnish it over time, or I just can sell it in a couple of years and make $30,000. I think people would start doing that because they would see that, but this is just an imaginary scenario.
Yeah.
Let's talk about the real scenario. Let's talk about what's going on here. Eddie's going to go ahead and put the article on the screen. I feel like my glasses were like licked clean by a camel. They're so filthy. They're like they got a film on them. I've been cooking all
animals
weekend.
Nearby that you're afraid of, or
yeah, no, I don't know. I was cooking all weekend. All right, mortgage demand drops as interest rates soar to over 7%. I guess you guys know where I got the title for this live stream from. The average contract interest rate for 30-year fixed rate mortgages is conforming loan balances of $766,550 or less increased to 7.24% from 7.13%. Well, I have a question for you before we. Why are you doing higher end home loans more than you're doing like lower end home loans?
No, we do home loans that are pretty close to the median home price. So we do most of our loans in between 250 to 500,000. So
Uh-huh.
we're not doing these like super expensive home loans, and it puts us in a nice position because I think that represents the majority of people who are buying. Most
Uh-huh.
people aren't in these like $1 million plus San Francisco or like Nashville type areas. You have a lot of people buying all over the US. And so we're kind of more in that mid to lower end of the market.
I was surprised on the luxury market at how much it was moving in the last month or so. It's cranking. I was shocked. Shocked. Anyways, applications for mortgages to purchase a home fell 1% for the week, and were 15% lower than the same week a year ago. How do you feel about that?
Um, I have no feelings. Yeah, I'm a real estate AI. I have no feelings here.
Oh, okay. The ARM share of
The,
mortgages demand rose last week, which often happens when interest rates rise. So how do you I want to know, like I am not team ARM unless you really know what you're doing with them, right? What do you think about an ARM, a mortgage ARM?
Yeah. Well, okay. We'll go back to the applications. Applications isn't surprising as rates go up. We see applications dip. To me, it's
Mhm.
not really like a big indicator of anything happening unless it changes adversely or differently than interest rates.
Mhm.
ARMs, to me, is in the same bucket of people who are like, they either want to waive their appraisal contingency in their contract or they want to waive their home inspection. Same thing with arms. I would never suggest getting those unless you have a boatload of cash. If you can't say I have a boatload of cash, I wouldn't suggest doing these. There's situations in which getting them maybe in the future. In hindsight, you found out like it was a good idea,
Mhm.
but for a lot of people, they can also find in hindsight that it was a bad idea. And I just don't think it's worth the risk unless, again, you can say, I have a ton of money. And if I need to use it, I have this all available sitting here ready to go.
Mhm.
But for most people, I would not suggest an arm.
I concur. I concur. Mortgage rates rose for the third straight week last week, hitting its highest level since November. As a result, mortgage application demand dropped 2.7% compared to the previous week, according to Mortgage Bankers Association's seasonally adjusted index. The average contract interest rate for 30-year fixed rate mortgages with conforming loan balances of 766,550 or less increased to 7.24% from 7.13%, with points increasing. What does that even mean? This is like for loans of what is that? What is this? What does that even mean? What tell
With
me what that means? That paragraph means.
with points increasing, is that what you
Uh-huh.
mean?
Yeah. Well, it says
So
the average, like it's like conforming balances of 776,550 or less increasing. And then it says with points increasing 0.66% from what does that all mean? For loans with
uh,
20% down.
So basically, what a point is, 1 percentage point is I think like to think of it like prepaid interest.
Okay.
So
Yeah, I knew
it's kind
that.
of like when mortgage lenders give you a rate, everyone thinks that they get one rate. A lender can actually give you almost any rate that you want. So it's called a rate sheet. And so it's a list of all of the rates.
Uh-huh.
I'm just going to make up numbers here. Let's say 7% rate costs
Mhm.
you $0. So that would be 0 points. Or what you could do is you can kind of prepay interest.
Mhm.
So again, I'm making up these numbers here. So let's say we paid 1 percentage point. So on a $400,000 loan, that's $4,000. Now,
Mhm.
1 point is probably going to lower our interest rate by maybe around an eighth of a percentage point to maybe 0.25%.
Mhm.
So we could pay $4,000 up front and get us maybe 6.875% interest rate.
Mhm.
So that's what points are. So zero point 0.6 would be zero point 0.6 times the loan amount. Um, the other thing you can do is you can also get a higher interest rate and receive lender credits to help pay down your closing costs.
Mhm.
So a lot of people think that they only get one rate. And what's been happening in this market a lot that people need to be aware of is loan officers are showing people interest rates with
Mhm.
thousands of dollars of points. We're seeing people give us quotes with $10,000, $20,000 of points to get a lower rate, and all home buyers what a lot of home buyers only care about is the interest rate, but they don't realize how much money they're paying for it. And paying
Oh,
points is kind of this risk of you're trying to see, okay, it's going to reduce my monthly payment. Let's say I paid $4,000 up front. Well, if it
mhm,
reduced my monthly payment by $100 per month in interest, then I'm trying to find my break even. Well, that's
right.
40 months.
Yeah, I was gonna say that.
So if I refinance or sell within 40 months, I effectively lost money on that quote unquote investment. Right. So it's kind of this, you're trying to play this game of break even. And a lot
Mhm,
of people, they just feel emotionally connected to their interest rate,
mhm.
and pay all this money up front. And I just don't think it's a smart decision because the break even period can be so long by the time there's a potential ability to refinance.
Okay, that
So
makes
that was
sense.
a long explanation to your very brief question.
Yeah, but that like the way that they wrote that, they did not write that in ways that the typical person reading an article would understand, you know?
No.
No.
Yeah.
So, I mean, like, I need to be talked to when it comes to mortgages. Like, talk to me like I eat crayons, like, explain it
Well,
to me.
and mortgages are so boring. So I feel like it
Yeah.
just kind of, when I read stuff about mortgages too, it's just like, oh God, okay, I have to focus on this.
Yeah. Applications to refinance a home, which are most sensitive to weak moves in interest rates, fell 6% for the week and were higher than 3% the same week a year ago. So applications of finance aren't as good either. Who's going to refinance when you have a low interest rate, though? You know, you have to be in some
The
kind of situation for that to happen.
Yeah, there are surprisingly a lot of people who, well, I say a lot relatively. There are a good amount of people who are doing cash out refinances to pay down high interest debt, because it is better
Oh,
to get an 8% interest rate compared to 25% on a credit card. And so there are a lot of people who their home went up a ton in equity and they did have a lower rate, but they're consolidating everything. And even with, maybe they had $30,000 in credit card debt, at 25% interest, by taking cash out of their home, they'll actually be able to save way more money by doing that, paying off the credit card than having the 25% or higher interest.
is that normal? A 25% interest rate on a credit card?
For people who are in situations where they're like maxing out credit cards and need to be in that spot,
Wow.
it it wouldn't be out of the ordinary to run into a pretty high credit card interest rate.
I would I would cry.
Yeah,
Back
it's
back in
it's an extreme solution, but it can help people who are kind of facing like, I either do something like this or start looking into bankruptcy options or other types of consolidation options.
I got in my husband and I got into the credit card game, after we had
Oh,
kids.
fun!
Oh, terrible, terrible. But I'll tell you, like, I literally gave myself a schooling in creative financing. So, they would have like zero APR for a period of time, right?
Hmm.
So
Yeah,
I would transfer all my balances over from, like, because we had four like separate credit cards and they had a much higher interest rate. I moved them all over, and then when that APR was over, then another one would come up in the mail,
nice.
and I just kept doing that until I paid it all down. And I'm like,
Like
that was
a little
Christina's.
mini credit card Ponzi scheme. We'll take
Yes,
one, have the
yeah.
other.
It was all legal though. It was all legal.
Right,
I
right,
did
right,
it
right.
correct way, but I'm just like, that was creative financing for Kristina Smallhorn to get out of credit card debt.
Now, at that time, did they charge you a the balance transfer fee?
Well, no. So they had,
Okay.
like, if the balance had to be over X amount of dollars before you had to pay the fee, or it had to be
Okay.
under that amount of money. It couldn't be under like $10,000. We owed more than that at the time.
Yeah.
So, and then, yeah, and we did the home equity thing to pay down. We just because it was like keeping me up at night, and we did that home equity
Yeah.
thing. We refinanced
Yeah.
just to pay it all off. That was such a relief the moment I signed those papers. But this is how incredibly stupid I was. I didn't know when I was sitting at the closing table where this guy that was helping us out was taking $10,000 in fees, the mortgage broker guy that
Oh,
refinanced.
yeah.
This was back
Yeah.
before they had regulations on that. And I'm sitting there signing everything in front of this title attorney going, "We got such a good deal." And she's sitting there saying nothing, zip it. And then it wasn't until I learned real estate and I looked at those loan documents, I'm like, Eddie, he raked us over the coals. I had no idea. Thank God we
Yeah.
sold that house. Thank God we sold that
Yeah.
house.
I just want to throw in one thing to keep in mind.
Mhm.
If people are ever considering doing this solution, just keep in mind that, like, let's say you had a credit card, and let's say that credit card could have been paid down in 5 years.
Uh-huh.
Um, you don't want to go and refinance your mortgage and then turn it into, let's say, a 20-year mortgage. You just stretched out that debt from 10 years to 20 years. So it
Yeah.
lowered your payment. But there really is a trade-off in saying, like, okay, you have a lower payment that you're legally obligated to, which is really good. But you want, for people in that situation, if you were paying $1,000 a month minimum on the credit card debt, or maybe it was $500 or whatever it was, you want to continue making that minimum payment into the mortgage for the same
Mhm.
amount of time. That way, you're basically paying down that debt in a much easier way with a lower interest rate, and you're not just stretching it out further, lowering your payment. Because what a lot of people can do is they can end up back in the same situation, is they
Correct.
all of a sudden relieve their monthly obligations, and then it can be kind of easy to increase lifestyle costs or potentially get back into debt. And you really want to be disciplined about continue making the same payment, but instead of paying it to Discover or Amex or whoever, pay it into the mortgage balance, because that's where your debt got absorbed into with those cash out refis.
I had a friend that did that. She just she took it as, oh look, I'm free and clear. Now I can go travel the world.
Oh, yeah.
Yeah.
Didn't get to the root of the problem.
No. That is, yeah. Thank you for explaining all that. Applications for mortgages to purchase a home fell 1% for the week and were 15% lower for the same week a year ago. As home prices rise along with the interest rates, potential buyers' purchasing power is suffering a double whammy. Purchase applications declined as home buyers delayed their purchase decisions due to the strain of affordability and low supply. As it often happens with affordability, takes a hit. The adjustable rate more share of mortgages applications rose to 7.6%. ARMs offered lower rates and can be fixed for up to 10 years, although they are considered much riskier. Yes.
Mm.
Mortgage rates have eased very slightly over so far this week, but there hasn't been much economic data to influence them. That will change next week when an all-important monthly employment report is released. Well, let me just say this, and I want everybody in the chat to answer my question when Kyle gives his opinion about this. But every time the job report comes out, because I talk to people on a regular basis, and I know you guys do too. Does the economy in jobs feel right? Because I know people that have put out like 500 applications and still haven't got any response. I know people that have overly qualified for jobs and still can't find anything. I have a friend, it took her husband almost, I think, 9 months to find a job, and he is very highly educated in a very good, like he's been working the same company for eons. He's well seasoned. Took him 9 months to find a job. Whatever this number is going to be, it's probably, they're going to say it's great, we've added more jobs, blah 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 blah. But I don't feel like the jobs market is that great. What do you think, my friend?
I don't have a ton of insight on the jobs market here, unfortunately.
Okay.
I don't track what's going on with the jobs data too much.
Well,
And I also haven't done I haven't searched for a job in a long time.
yeah. Well, we work in jobs where you don't necessarily, like, if your mortgage company was to fire you tomorrow, it wasn't like you can't walk across the street and work for another mortgage broker.
Yeah.
It's same with me. Like there isn't anybody that I don't. Do real estate agents get fired for brokerages? I don't even know, because you pay them. You pay them
Uh,
to work there.
you definitely could.
I guess like a code
My
of ethics problem, maybe.
Yeah, my dad's a real estate broker, and he's fired a few people. But it's all been for, like, they were
Ethics
bad
stuff.
people who did bad
Mhm.
stuff. So yeah, they probably should be let go. If you want to, I can kind of talk a little bit about why rates are still high
Mhm.
with the whole Fed decision and everything like that, because I think people get kind of confused. Or we can kind
Mhm.
of wait if you want to jump into something else.
Yeah, well, we can do that, but I do want to read some of these comments because they said the jobs are in China. They said they created AI for fast food robots, basically. I love this Walmart life, Uh, the job market is not great unless you want to be a teacher. Yeah, because all the teachers are leaving. Stats show, yes, a lot of part-time jobs, but less full-time. Last time full-time jobs fell in 2023. Yeah. High-tech layoffs are horrific. Computer science is no longer a mega well-paid career, especially for new entrants. Yeah. Yep. It's wild. It's
Yeah.
wild. I just like looking at Kyle. Dude,
Thank you.
see?
Thanks, JT.
Yeah. You're dreamy. You're dreamy. You
So
got the
so
voice like
silly.
moisturizer. People
Well,
want to look at
I'm
you.
not real. Don't forget.
Yeah, oh, before you get into the reason why interest rates are high, I want to tell you this, and everybody in the chat will blow up. The CEO of BlackRock said his outlook for the economy is optimistic because he said that the pressure that's been put on the public, they're able to withstand it because they still have money from COVID. There's still COVID money flying out there. And
Oh, like the PPP
yeah,
stuff?
yeah, he said that
Okay.
we still have money out there that needs to be spent, and that like the economic shift that's happened because of COVID, it hasn't really uh put the pressure like some economists have said. He said that we're still in great shape, is what he said.
I'm glad they're doing so well.
Yeah, I'm like, what ivory tower
Uh,
are you looking at us from? What are you talking about? Have you seen the price
Overjoyed
of
said,
oil?
"Yay, optimistic for BlackRock."
Yeah. And then the other thing he said was like, "Oh, and we're gonna slow down the amount of investing in residential. And we're gonna really look at commercial." So you know what that means? That means that they're gonna buy more residential properties and steer clear of commercial properties. That's what it really
Yeah.
means. But he also,
Yeah, or
go
maybe
ahead.
they're disguising it as like apartment complexes, more as like, "Oh, this isn't resident. It's not single family residential. It's apartments," and getting in more to that side of things. I'm curious because I don't know a lot of companies that would be interested in getting into like commercial investing, especially because it doesn't seem like a lot of businesses have gone back to um like back to offices quite as much.
Right, but they say it's going to make a comeback because it helps the economy, and so they've been putting more pressure on big buildings to bring people back to the office, because they can't have commercial real estate fall apart. So they're trying to wield their little magic to make people
Yeah.
come back to the office. But the other thing he said was that the notion of AI taking over jobs is ridiculous because it costs too much money in electricity. And since we have such a strain on the electrical grid, to make all these jobs go to AI would be ludicrous. So he also said that.
Hmm. Interesting.
Yeah,
Okay.
yeah.
So they're
Again,
just talking about whatever they want to. These are like, I
all
feel
the
like so
things.
many. It's like they're having conversations with their friends, but it's out loud in front of reporters for some reason.
Yeah, they just live in a different planet than the rest of the world. As you pull up to like Wendy's and they're like, "Hi, can I take your order?" And it's obviously AI. They've replaced a person, and then the thing comes up on the screen and you can just tell them, it shows the words.
Okay, hot take. I love the new ordering robot kiosk things. I don't. I hate when feel like I don't want to talk with anybody, and I want to get food that feels terrible for my body, and I don't want to be like, "Hi, how are you? I'm having a really awful day." I just want to talk to a robot and get it done. I know maybe not everyone's in that camp with me.
I am kind of at the point of like, the thing is that we've lost so much social interaction. I think the fact that if we were forced to have more social interaction, that it would make for less crappy people. Because like people have gotten their fuse is this short now. Their fuse is so short. And so they'll do everything on their apps and they do everything on their phones. And it's making people just more tense over stupid crap. So I think maybe we need more forced interaction. I think that's what it's happening. But
Oh,
let's talk about why
Wild
interest.
Williams said, Kyle, because you're special needs. Okay, I'm getting called out.
Everybody's got a little touch of the tisms. I mean, I do, my kid does, whatever. Anyway, let's talk about why interest rates have remained high for so incredibly long. Because you're the expert. Tell us.
Yes, I am the real estate AI that is single-handedly setting the interest rate. No, so I think with like a lot of people hear about the Fed and the interest rate and the Fed's, they think the Fed is setting the interest rate. And a lot of people feel like somebody's out there with a little dial and they just get to set interest rates to whatever they want it to be. And unfortunately, that's not true because that would be really nice.
Mhm.
Basically, what's happening is we have a lot of inflation. I know last time I came on here and we talked about inflation. Included in inflation is also corporate greed. Inflation just means the cost of things has gone up. That's the big word we use for it. It doesn't
Mhm.
mean that we're escaping responsibility for, or corporations are escaping responsibility for price setting or greed or anything like that. So with inflation not being as low as the Fed wants it to be, they have a couple tools that they can use. And one of those tools is the federal funds rate. And basically, this is the interest rate that is set for banks when they lend money to each other overnight. And so that's all the Fed funds rate is. The Fed does not set mortgage interest rates.
Right.
It really can only set the Fed funds rate. And so what a lot of people feel like is they hear about the Fed rate cuts coming up and they think that means interest rates are going to change. Interest rates are mostly influenced by inflation. And the reason why is because in the US, we have this really strange mortgage market where mortgages are 30 years long, which is kind of insane to think about. If someone asks you for money, like Christine, if you asked me for money and said you'll give it back to me in 30 years, I'd be like a little bit weirded out by it because I don't know what's going to happen in 30 years. I don't know if I'm going to be here in 30 years. I'm probably going to morph into a full AI at least in the next 15 years. So what ends up happening is inflation erodes mortgages. Investors get less and less money as time goes on when inflation is high. And so that's why when inflation goes up, we see mortgage rates go up because investors expect a higher return because inflation is going to erode the return that they're going to get from mortgages. And so to the Fed, basically what's happening right now in the economy is think of the Federal Reserve is inside of a car and the car is the US economy. And the Federal Reserve is sitting in the driver's seat and they're like, we want this car, the US economy, to only go a certain speed. And for a while, when we were kind of just getting out of COVID lockdowns, inflation jumped up a lot. So that car speed was going way too fast. And so the Federal Reserve, as a driver in the car, only has a couple tools to slow the car down. And basically, what's kind of happening is the Federal Reserve is kind of pressing on the brake by increasing the federal funds rate. But the problem is, you ever been in like a car where the brakes don't work super well, and
Mhm.
like the brake is kind of gummy, and you're like, I am about to run through the stop sign. They're slamming on the brake pedal as hard as they can, but the car is still moving faster than they want it to. And so that's what's happening with the Fed funds rate is they're leaving it where it's at in hopes that it slows the economy down, it slows the exchange of money, and that hopefully will bring down inflation, which should bring down mortgage rates. So anytime we get data that comes out about inflation not being where the Federal Reserve wants it, and the Federal Reserve saying we're going to keep applying brake pressure because the economy is going too fast, is why interest rates go up instead of the other direction. And what a lot of people were hopeful for this year, like you mentioned at the beginning, is that, well, maybe we'd be closer to 5.5% rates at the end of the year because the expectation was the Federal Reserve has really slammed on the brakes. But what people didn't expect is that the economy would still be moving forward, would still be growing, even with as much brake, as they're like standing on the brakes and it's still not slowing down. And so that's why we are seeing interest rates where they're still at. If we see inflation start to come back down further, then yeah, we're going to see interest rates lower. But at the moment, the Federal Reserve is doing as much as they can, but the economy is still growing faster than they want it to. The car is still going faster than they want to, which is why why interest rates are still where they're at and kind of creeping up just a little bit more.
I think interest rates got well, I think the reason why we're in this situation, we left interest rates too low for too long. You know, like during the pandemic, they were too low for too long. The housing market
Yeah.
was insane, and they knew it, and they wouldn't raise it, and they should have. They should have. They were too scared though. They were
Yeah.
afraid of what was if they were afraid of what was going to happen because everything had a knee jerk reaction during COVID, and they were too afraid, and they shouldn't have been.
Yeah, because at that same time too, I think afraid is like exactly how the Federal Reserve and I think a lot of governments were feeling at that point is
Mhm.
we can do all this, but the economy cannot slow down. And so what was happening with mortgage rates particularly is the Federal Reserve, another tool that they have on top of the federal funds rate is they
Mhm.
can buy and sell mortgage-backed securities. And
Correct.
so they were purchasing billions, tens
Yeah.
upon hundreds of billions of dollars of mortgage-backed securities, which I won't go into the whole economics of
Mhm.
how them buying it lowers rates. But 3% rates are not going to come back unless the Federal Reserve purchases this at the same pace they were. But what they're doing right now is they're actually offloading. They're actually
Yeah.
selling and letting bonds mature. And so they're doing the opposite of what was happening during COVID.
Mhm.
So I know a lot of people feel like, oh, well, I'll just wait till we get back to the threes. We're
Mhm.
not going to get back to threes unless something happens that instills an equivalent amount of fear in the federal government to begin dropping federal funds rate all the way down, and then also doing the same thing, purchasing billions and billions of dollars of mortgage-backed securities to lower rates back down. And I just don't see that happening uh, anytime in the near future. Again, unless something crazy happens that
I
I can't
never
predict as
thought
an AI.
after the last housing crash, I said I'll never see rates in the low fours and threes again. And when I did, I was like,
No.
wow, wow, yikes, yikes, fruit stripes. You
Yeah.
know? Yeah. So B14 Life says, question, do you think the refinance interest rate will go down? I have a 6% interest rate and with little crying emojis. Do you think the refinance interest rates will go down to under 6?
Not anytime soon. So the refinance rates and purchase rates are really similar.
Mm-hmm.
So they're not super different. And really in the near term future, I don't expect so unless you're looking at like a government loan like FHA. Streamline, maybe by the end of the year, you might be able to see something around that range.
Mm-hmm.
But for a conventional loan, I wouldn't expect it for a little bit, unfortunately.
Somebody a couple weeks ago said, what is the lowest cost of a home that you can finance for 30 years? Now, doesn't every bank program have their own amount that they'll lend? Like some of them say we won't lend anything under 65,000. Doesn't FHA have a requirement like that?
Yeah, so it's usually set by there are like federal rules, but then
Uh-huh.
each lender also has their own rule.
Okay.
Most lenders are going to be running around 100,000 as their minimum loan amount,
Mm-hmm.
which I can explain why. But if you're looking at below $100,000, probably going with like a small local bank or a local credit union is your best option there. Mainly because anything below 100,000, like keep in mind, mortgages have fixed costs. No matter if you did $1 million house or $100,000 house, it's usually the same amount of like working hours that staff has to put into that loan. And
Mm-hmm.
so that can become a fixed cost, which on $1 million loan, there's way more profit to absorb that. And on those 100,000, sub $100,000 loans, mortgage lenders can end up losing money. And even right now, the average loss for independent mortgage banks is, I think, around $1,000 per loan.
Mm-hmm.
Most companies are not making money on loans currently in this market, and so those smaller loans become even more difficult because they have fixed costs to make up for.
Um, Somebody said that the whole reason for the housing market to look the way that it does was the fact that they did do the 30-year fixed rate mortgage. Like that was what caused, that was the catalyst to increasing home prices. It was the catalyst to, like when interest rates got so low, because it used to be back way before I was even thought of. it used to always be balloon payments, and it was always your local bank
Mm,
that would do them. And so they had to take on the risk, and they didn't really like writing home loans. So they were quick to foreclose and they didn't like dealing with foreclosed properties. And it wasn't until
yeah.
after the biggest financial crash of all time, that's when they decided, the federal government decided to step in and say, hey, we need to give opportunity to people to get into houses. And in order for that to happen, we could space out those payments over 30 years. But they say when the government stepped in and made that possible with having that fixed rate mortgage, that's what caused these last two crises, because when you
I
when you
think
spread out
with
payments over
as
30 years, it makes it more affordable.
I think as far as I'll answer this and we can get to Crystal's question, which I know is up here. I love Eddie just queuing up these questions. It's so nice. The okay, so like in other countries, for instance, like Canada, they usually go, and I'm not super familiar with Canadian mortgages, so I may
I
be
think
a
it's
little bit wrong
7
here.
years.
It's
Is it
I
seven?
think it's around 5 years that
Okay.
they have their mortgages, and they're amortized over 30, so you have kind of a similar to a 30-year payment.
Hmm.
Um, but it effectively, in our terms, has to be refinanced every
Correct.
5 years. And I think that's a
Correct.
healthier mortgage market where you're not running into all this like margin compression and weird things that can happen in the US market. But also,
Hmm.
Canada's home prices are insane. Like, Canada, from what I've seen, has a worse affordability problem than the US does.
And they had
And
it
so,
way before the pandemic. This is like,
yeah,
it's a 10-15 year problem that they've had in Canada from this.
yeah.
They had
So
institutional investors and foreign investors buying
mhm.
up properties, leaving them vacant on top of it all.
Yeah, it seems like their issue with prices is primarily a policy decision. So I'm
Hmm.
curious if we ever switch to a market or mortgage market like that, where things had to be, it was shorter duration mortgages.
Hmm.
If that would, I don't know that it would
You
alleviate the
imagine the
price problem.
uproar that would happen?
Oh, oof.
That would
It would
be,
be,
we would have content for months. So, Crystal K says, question, why is the VA still charging high demand county appraisal fees? This is a good question because I do not even know what this means. So have at it. Tell us what this means.
sure. So first of all, like, uh, so every loan, pretty much every loan has to have an appraisal.
Of
So the
course.
mortgage company knows how much the home is worth. Is it worth what you're paying for? VA, because VA appraisals are a little bit different than other types of appraisals, you have fewer people who are certified appraisers who can do that. So that already makes the demand for VA appraisals high.
Mhm.
So you have fewer VA appraisers, and then in either a high demand county, again, you're just running into a shortage of appraisers. What was the case for a while too was often in more rural areas. For instance, out in Ohio, in a more rural area, there might not be a local VA certified appraiser for quite a bit.
Mhm.
I would talk with I talked with an appraiser once who was like, I drove an hour to get to this property. And that reflected in the cost of the appraisal as well. So in those higher demand places, if they have a shortage of VA appraisers, it's just kind of general how the market works. Higher demand is going to increase the prices of things because these appraisers are working probably more hours than they normally would be doing and expected for quicker turn times because there's such a high demand compared to how many appraisers there are.
So basically, it's a supply and demand problem. That it's higher
Yeah,
because
with
there isn't,
appraisers.
yeah, there isn't
Yeah, and
enough
it's not
supply.
I know the whole appraisal field is going to be really interesting in the next 5-ish years because it's difficult to become an appraiser. And not a lot of people want to get into the appraisal world because it's there's a lot of training and requirements for a pretty low pay. On a realtor side or loan officer side, theoretically your income is kind of unlimited. It's as much as you're willing to work and put into it, you can make out of it. But with an appraisal or an appraiser, it doesn't really work that way. You're getting paid pretty limited fees on deals, and you can't create more time for yourself. So it's going to be a
I
weird field, I think, in the next 5 years.
I think that the appreciation and when people don't understand what an appraiser does, they think, oh, well, all they're doing is they could just take an algorithm and a computer and they can figure out the costs by doing this. But there's so much more to it than that. And I think it's an underappreciated profession. We have this one guy that people call the deal killer. And I'm like, he's not the deal killer. It was overpriced. Yeah, you found a buyer that was willing to purchase it, but he was right. He was right. And they give this guy so much garbage. And I never had an issue with him. Never, not once, because he was always fair every single time. And he was like, "You're one of my favorite real estate agents." I'm like, "Yeah, it's because I don't hate you." And I'm like, when it doesn't appraise, it's not, it's not because he did it. It's because it wasn't worth it. And
it's usually only the buyer when we run into those situations where an appraisal comes in short. It's usually only the buyer who isn't furious. Often when an appraisal comes in short, it's like the listing agent's furious, the seller's furious, everyone's mad. Well, those people want to get a paycheck. The only people who are mad are the people who didn't get a paycheck when the deal closes. But the person who usually isn't upset is the person who benefits from a short appraisal of saying, yeah, someone helped to make sure that you didn't overpay for this property. And I know you really wanted this, but this is a more realistic price of what you want to pay. And if you want this property, you can pay for it in cash if you want to. But an appraisal really does benefit a lot of buyers in making sure that the price that they're paying is supported by real market data and not just hype that's happening in that market.
Well, years ago, I did have an appraisal that didn't come in right. And I was like, not from the deal killer, but from another person. I was like, how does that even physical? It's in a neighborhood. Everybody, let's just say every single house is 1,300 square feet, right? And they all sold for $250. But for some reason, this house was appraised at $225. The condition of it was fine and everything else. And they had taken comps outside the neighborhood when there were literally, like 20 sales that were at the 250 mark. And I'm like, absolutely not. No, indeed. That was like, it was wrong. That was incorrect. And so I fought on that one big time.
Yeah. Nice.
Yeah. That was like, I didn't know if he had been drinking that week or like he was looking at another house. Cause I'm like, that house is 10 miles down the road. Why didn't you use the one that was 3 streets over in the same exact neighborhood? That makes no sense. None. Zero.
Someone was asking about AI and appraisals.
Yeah, there's the desktop appraisals.
Yeah, so Fannie Mae desktop is slightly different, but Fannie Mae and Freddie Mac both have value acceptance and automated collateral evaluation, which are basically appraisal waivers. Those are the terms they use for it. I don't know. They don't publish like what level of data analysis they do. They just say it's like data analysis or market data analysis that they're using for these. But I'm sure there's some level of machine learning at minimum. I don't know if it would technically branch into the AI world, but some sort of machine learning or risk evaluation happening with machine learning through market data that they're giving appraisal waivers for. So it's not fully AI in that sense, but very similar to what I think a lot of people would say as AI making some of those decisions.
Well, AI didn't really necessarily do good for the Zillow buyer back in the day. I don't know if you guys remember back when the pandemic started, Zillow said, "Oh, we're going to get into buying a home business. We're going to start buying homes." And they used their own appraisals, their own estimates in order to do the analysis for what they should offer on these houses. And a lot of their appraisals weren't even there. And so they would say, well, my Zestimate says that's $450 and we want to win the house. So we'll offer $475. And that was a run up on a lot of prices, especially like in Phoenix, Arizona. And then they got the house and they were thinking that the prices were still going to go up. And then all of a sudden they were like, oh, we really screwed up. And they had to dump these houses and they had to dump it.
Yeah.
Like they ruined themselves, So I don't know if necessarily like any, smart company will ever go back to only buying houses according to what the AI says.
Yeah.
That's not smart.
Whoever was in charge of that department of Zillow, I feel like must have been given some sort of like performance metric that they had to hit and was way too aggressive with it because they just rolled it out way too fast. I feel like without any sort of testing.
Well, can I tell you
way too much money on the line?
let me tell you some backroom tea on that. Like everybody's going to learn some backroom tea on that. So they had sales associates that were writing up these offers. They had basically a little pool of real estate agents that were writing these offers. And they said, because the market was so hot, if you win the bid, doesn't matter, just win the bid. If you win the bid, we'll give you a bonus on top of it all. So they were writing up all these houses, as many as they could, and they didn't care how much it was over because they wanted their bonus. So they just kept writing out house. Like it wasn't like there was no
That sounds
overseeing.
very similar to Wells Fargo's, like if you get people to open checking accounts, wasn't that the problem they had? That was they were
Yes,
incentivizing
they were
like bank employees
incentivizing
to
the
open accounts.
employees to open them up, and they were making fake accounts under people's names. That's
Hmm.
true.
Interesting. It's
But
weird
that's
how
why
that
they
doesn't
lost
work.
so much money doing it. That's another
Yeah.
reason. It wasn't just that they were overbidding for homes. It was on top of the fact they were giving these people huge bonuses. So if you're going to incentivize them on a crappy product, they're going to still sell it. I've seen that in a lot of companies. They're like, you want me to sell this? This is garbage. Like this isn't going to do anything for the company. It's going to cost you money. But if you're going to want me to sell it, I'll go ahead and sell it.
Yeah.
Companies do that all the time. S. Stewart says, if employers have to pay larger wages due to high rent costs to their employees, they have to increase costs. Is this even measured, correlated with the Fed inflationary conversations? I'm going to tell you this: wages have not increased. They have not increased to the rate of inflation. That's well documented. So, food costs compared to income is the highest in 30 years. On top of it all, like it's stuff that we need, like insurance, that inflationary rate is way higher than it has been. It doesn't match our incomes. In the 30 years since the food costs ate up this much of your income, according to the U.S. Labor Department, Americans consumers are now spending 11.3% of their disposable income on food. According to the latest USDA available, that hasn't happened since President George H.W. Bush. WHW
Yeah.
W was eating eating continues to cost more, whether it's in restaurants, takeout, or at home. Yeah, well, we just haven't met the haven't been meeting costs. That's for sure. Is there any correlation to the Fed inflationary conversations to you?
Yeah, as rent. So it wouldn't be the employers paying higher wages that would increase inflation, but higher rent costs would show in inflation numbers.
Right, because they used to say like you can't go over how much. What is it? The percentage again? 27% of your income should go to shelter. Is that what it was? Is it 20? What was the number that they said you wanted to keep it around X amount of your wage? What
Who
percentage?
said this?
Like it was like like my mom always says. I think it's
Oh, oh,
25%.
oh, oh, oh. Oh, yeah. Okay, I see what you're saying. Yeah,
Mhm.
everyone has so many different rules that it's hard to keep track of who says what, but it's usually around
Yeah,
that like 30-ish%
yeah,
number.
27 to 30%, and now it's like well, shelter right now for people is like around 42% of their income because
Yeah.
like the costs have gone up so high, and people that are paying rent, I mean, they're seeing increases, and they said that rent costs were supposed to come down by now because they had put in so much to multifamily investing. Like a lot of investors went through and started doing multifamily units, lots of condos, townhomes, and that was supposed to offset how much rent had gone up. Well, here
Mhm.
we are in 2024, and those rent costs are still going up for the majority of the United States. Now, I know there's pockets, and every real estate market is different. There are pockets where you're seeing a decrease in rent, but not enough areas, that's for sure.
Yeah.
Ian says, why are potential home buyers taught about hidden tax of homeowners insurance after the homestead exemption is gone? They can no longer afford the house when the insurance goes up. So tax exemption is different in every single state, right? Like I have tax exemption on my house, and the only way I get rid of tax exemption is if I was to move to another house or buy a second house, the second house wouldn't have tax exemption. The first house will always have tax exemption until it's sold. I don't know of anybody that doesn't have tax exemption through the life of it once it's been filed. Now, some areas require you that you have to file tax exemption every single year when you file your taxes for your property taxes, but that remains on the life of the loan, and not every area has a tax exempt status. The other thing that
Yeah.
I do think that there is a lack of education, whether that's with real estate agents, loan officers, anybody that's in that transactional period, that when you buy a brand new house, a lot of times when you're getting the property tax escrowed, you're only paying the taxes for the lot for that first year. Then the second year, then it becomes the dwelling, and they didn't realize it. Some people weren't taught that. I think there is a problem
Oh,
there,
I see what they're saying.
because
Yeah,
now
because
that's been adjusted.
in our area, like you don't get a homestead exemption unless you're above 65.
Right.
So I know in other states it's completely different. So yeah, I
Mhm.
mean, it's a lot of people do need to be aware of what's happening in your local county as far as
Mhm.
taxes and tax incentives, because it really can change county by county. There isn't just like one general. There aren't a lot of general tax rules across the entire U.S. Unfortunately.
Yeah, but there sometimes with a tax exemption, if you are over 65 in some areas, they'll reduce how much you have to pay in property taxes. And then in some areas too, if you're if you're a vet, if you're a vet, they'll even give you more of a tax exemption. So it's always good to look into what your tax exemption is in your specific state. Some people didn't even know that you were supposed to file it. The people that bought our old house never knew to file it, and they were paying an exorbitant amount, but they didn't realize they were paying an exorbitant amount because they moved from Texas, and
Mm,
the property
yeah,
taxes in Texas seemed like they lined up exactly what they were in Louisiana. I'm like, if he files the tax exemption, he can cut that a lot,
right.
with like another $1,000. I mean, I would. Everybody wants another $1,000 in their pocket. That's nothing to sneeze at. So Peter has a question and says, how does our nearly 35 trillion in national debt impact interest rates now and in the future? Oh. If the US defaults on its debt, it means that the bonds investments become much riskier, and a spike in yield with mortgages rates will likely come ensue. So basically what they're saying is if we don't pay our money, our interest rates for mortgages will go up. Is that what that means, Kyle?
Yeah, there's definitely a strong possibility of that. I think what
Mhm.
also happens too is not just the debt that already exists, but
Mhm.
any new debt that gets issued through treasuries.
Mhm.
Those also compete against mortgage-backed securities in the bond market.
Mhm.
And the difficulty there is as the price of bonds and interest rates have an inverse relationship. So as the price goes down, interest rates go up. And
Mhm.
so, if the US has to issue tons of debt, tons of securities to be able to pay for new things, even things like student loan forgiveness or big projects or military aid, if they have to issue debt to do that, then in bond markets that can then lower, kind of dilutes things, lowers the price, and can increase the yield or increase the interest rates that are on the other side. And so that's more of the impact than just the existing debt that currently exists.
Good answer. Good answer. Did
Thank
you?
you. Thank you. Thank you. Thank you.
Yeah, I like it. Do you ever watch a Family Feud?
Yeah, every once in a while.
Okay, so
I like when it's
whenever
always
a
like
family
Steve
member
Harvey
does
is
a family member will do the dumbest answer, and the whole family be like, "Oh yeah, good answer, good answer." Like,
yeah, backing up anything you could possibly say. Yeah, yeah, that's
yeah,
great. That's great.
yeah. Lawnmower says, "Will third-party appraisals be considered on property tax appeal? Will third-party appraisals be considered on a property tax appeal?" I think that's a state thing. That would depend on your county and state. Oh my god, I want to tell you guys some gossip. Oh,
You've got so much tea. I need to start bringing some tea when I come on here.
okay. In my county, our tax assessor guy, right? He's been our tax assessor for 12 years. I mean, none of you guys care, but this is so juicy. I have to share it. He's been our tax assessor since 2012. Sorry, he's been our tax assessor. Uh, so he gets on board, young guy, young whippersnapper. He decides that he's going to revamp the whole entire website, right, for the
Okay.
tax assessors. So now we have like really fancy maps. You can determine how much the lines. He gets drones up in the air to make sure that we get reimbursed for all the taxes that we hadn't been collecting because people hadn't been out to some of these rural properties in so long. I
Oh,
mean, this
oh,
guy's
okay.
all over the place, right? Like people loved it. He went in with his little computer doodlery things, did a little fudging of the numbers, and he hadn't been paying the correct amount on his property taxes for a very long time, and he got arrested.
That's fun.
Yes. Yes.
Accused of malfeasance, computer tampering.
Yeah, so
Nice.
he went in there with his little computer knowledge. He didn't think anybody would figure it out because he was the only one that knew how to run it, right? But the thing is like you knew how to run it in 2012. You've hired all these other people. We've all had a computer education since then. You were going to get caught. We were coming up with all the scenarios of how this guy got caught. We were saying, did he get a try to do a refinance? And that's how he got caught. Or did he try to pay his property taxes? And the lady that got the check was like, how come his property taxes are so low? You know, like how was it that he got caught? Because I bet he didn't get caught from computer forensics. I think it was just something so dumb. Like an appraiser was in the area doing a refinance and was like, why is this guy's property taxes so low? And he turned him in. Like, I don't know how he got caught, but I love playing that game in my head.
It said he went by the name Mert.
Well, the Mert Smiley is the tax assessor commissioner. Like he's the one that oversees.
Oh.
But this guy was right under him.
Oh, okay. Justin, that's his name.
Justin Champlin. His family runs a title company called Champlin Title in the area.
Yeah, it doesn't say anything about how they figured that out.
They didn't tell you who spilled the beans. So that was some real estate gossip in case you guys really wanted to like dive into that. It says B14 Life says in most states school taxes are high. Why is people having to pay them if they don't have kids or kids in school? Isn't it federal government responsibility to pay per child or homeschool? That if it was federally funded, all property taxes is what funds schools, right? It would be a more even playing field if everybody got the same amount of tax dollars when it came to their schools. That hasn't been that way since the dawn of time. They say schools are run and funded by what the property taxes are for that specific area. And who knew that the correlation to the people that pay the higher property taxes have much better schools with better students that, you know, have higher educations. Like, wow, that's such an interesting concept. Who actually thought that would really work? And what do you know? In poor areas that don't collect as much of property taxes have poorer schools and a really bad education system. Wow. The thing is that property taxes are associated with schools, whether you have kids or not, because of the fact that they're spreading the cost across the whole entire community.
It's kind of similar to saying like,
I don't drive a car. So
like,
why should I have to pay for roads?
Yeah, it's like my tax dollars go to paying for. That's what the example I was going to use. My tax dollars go to paying for roads, but I don't drive on that road over there, so
I don't want to pay for that road. I don't want to pay for that road. I don't.
And just to clarify, we're not making fun of this person. We're just drawing an example here for fun. So,
right.
Yeah.
I don't use the telephone lines. Why do we have to pay for those to be repaired? You know.
That's kind of how government works, is taking those costs that would be a burden for a small percentage of people that use it and spread it out amongst the whole in hopes that it helps everybody.
Socialism. Yeah. That's what that is. Communistic. Question.
Privatize all the roads.
Yeah. Question. Can you briefly cover assumable mortgages? Oh, you do this. This is not on my
Sure. Watch. Are those fire trucks? This is really serious.
Yeah.
Do we have
it's
a siren
emergency.
sound? Okay. Um, yeah, so an assumable mortgage, most government loans are assumable. So think like FHA, VA loans, conventional loans are not assumable. So here's what it means. Let's say that my house, let's say I have an FHA loan and it's 3%, and Christina wants to buy my house. And instead of Christina going out and getting a mortgage at, let's say, let's just say 7% for easy numbers, she would like to have my 3% mortgage. So on an FHA loan, she could actually take over responsibility for my mortgage instead of getting her own. Now, the big problem with assumable mortgages is number one, they're not profitable for most lenders. And so they don't have large staff dedicated to it. So they're going to take a long time, like expect months to get an assumable mortgage done. The other problem that you're going to run into, like, so you still have to qualify for the loan. It's not just like I can hand it over. Christina still has to show that she has a credit score and income that can support my mortgage payment at 3%. The big issue with assumable mortgages is, especially with the increase in home values recently, is I'm just going to use easy numbers here. Let's say that I bought my home for $300,000 and currently I only have $200,000 remaining on my mortgage. So Christina could take over my 3% $200,000 mortgage. The only problem is my home value, again, easy numbers here. My home value, let's say it went up to $400,000. Christina comes in and she wants to take it over, but I have other buyers willing to pay me $400,000. So I say to Christina, great, I'll give you the $200,000 loan that you can take over at 3%, but I'm going to need the other $200,000. Like, I'm not just going to give you this and not make a profit because everyone else is willing to pay me. So why would I go through this long process with you if you're not going to give me the value of my home? So Christina has to figure out where she's going to come up with an additional $200,000.
Mm-hmm.
That's the problem that most people run into with an assumable mortgage is, yeah, the interest rate's great, but where are you going to get the money for that? No lender that I'm aware of will do a loan for an assumable mortgage. Again, it's just not profitable. It also adds a weird level of risk because now there's two liens on a property instead of one. And I'm not aware of any lenders that are doing that. So Christine either needs to figure out, she either has $200,000 or she comes up with it somewhere. But if she had that money to make up the difference, then yeah, she could assume my mortgage with the lender. And the way that
like, that's $200,000 cash. Unless you have like,
yeah,
have it, you know?
Right.
That's a lot.
So the process to do that is if a seller has like an FHA loan or a VA loan, you would have to contact their lender. You can't go through any lender. You have to contact whoever's holding their mortgage, see if they're willing to do an assumption, and then take it over. So it's cool. It's a cool concept, but they're really difficult for people to actually get through. They're just not the most realistic option.
So the best, if to make that like really like satisfiable, the mortgage rates currently would have to be like extremely high, and then home prices would have to be so low where there wasn't that much give for the person selling the house. There wasn't that much that the home buyer would have to give in equity that was left over from the loan. That would be the only way to make that work.
It would work. Yeah, it works best for homeowners who don't have a ton of equity in their home.
Right.
Because then you don't have to come up with a big difference. That's when it works best, but most people aren't in that situation.
Today.
And so, yeah, they usually have a lot of equity. And so they're usually, especially when they're getting multiple offers and someone's over here saying, I'll buy your house in cash and we'll close in 2 weeks, or I'll buy it with a conventional loan and we'll close in a month, versus I want to assume your loan and it may take 3 months and it also might not work. To a seller, they're like, well, I don't really care. I just want to get money and sell this as quickly as possible is sometimes the issue.
Question to Kyle. Do you ever do a manual underwriting for people without a credit score?
Yes. Was there something in the private chat that I was supposed to be aware of? Oh, maybe not.
No.
Yeah. So manual underwrite does work. Yes. For conventional or FHA loans without a credit score. That is an option that you can do.
Was Eddie sending you love notes in the private chat?
I thought there was a mention of a private chat, but maybe I didn't see.
Maybe I wasn't supposed to know about it.
I see. I did send it in private chat. Yeah, Eddie and I have a whole conversation going. We have all this lore happening that you're not aware of?
Yeah, maybe that's maybe what's going on. Whatever, that's fine.
We have a
You know,
secret life without you.
yeah. Well, if anybody wants to get a hold of you and your secret life, all you have to do is go to Win the House You Love over there on YouTube. You can check out Kyle and all his great content. If you want to listen to this as a podcast, you can actually go to just type in Kristina Smallhorn Real Estate for Everyone on all the podcast areas. And if you're looking for a real estate agent in your area, all you have to do is go to my website, KristinaSmallhorn.com, and hit one of the pink buttons. Make sure you fill out all the
Do we get feet?
Yeah, and he's going to show the feet pic. I need to change that. Yeah. And he's going to change it. Look at
Here, I'll
that.
get my socks in there.
Yeah.
I can't show bear for free. Wait. Oh, my foot can't go up that high.
Yeah.
All right, that's the best I can
Somebody
do.
said my feet look dirty, and I'm like, they're not. See, they're pink at the top, but the shadow makes the bottom makes them look dirty. I made sure I had a pedicure the day before that. All right, everybody. I hope you have a fantastic week. This was a great conversation. I appreciate every single one of you, and thank you so much to the moderators. I know everybody was saying, "Don't talk about politics." I saw your comments. We weren't talking politics. We were just razzing. So, everybody, I hope you have a fantastic week. We'll see you next week. Yeah. So long, farewell, Vita, say goodbye. And he doesn't even have music going on.
I know, what happened to the music?
I know, man. He's slack. Oh, you know what it is? He's breaking
Why?
There we go. What kind is it? Like what is it? Rave music.
So that's some deep house.
Yeah. Get some glow sticks going.